Today, mortgage lending enters the danger zone. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. The latest housing finance statistics from the ABS were released today, so we examine the results. And by the way, if you value the content we produce, please do consider joining our Patreon program where you can support our ability to make great content. Here is the link. Before we get into the detail, it's worth noting that the latest data from the RBA, in both its statement on monetary policy, which is in my view insanely positive, and the monthly chart pack, does show that household debt is still rising, so that the 190 plus level will continue to be exceeded. And the household wealth in housing is declining, and quite fast. Coupled with the continued decline in the household savings ratio and the higher costs relative to income growth, the stage is set for more trouble ahead. Remember that availability of credit drives home prices, so reduced momentum in lending also and directly translates to falling prices. So now to the ABS data, where there was further evidence of the lending slowdown in spades today, with the housing finance statistics to September 2018. Looking at the trend flows, first, new lending for own occupation fell 1.7% compared with last month, down $235 million to $13.78 billion. Investment lending flows fell 0.8%, down $69 million to $8.96 billion, and owner-occupied finance loans were flat at $6.24 billion. Refinance loans as a proportion of all flows rose to 20.8%, and we continue to see this sector of the market the main battleground for lenders who are trying to attract lower risk existing borrowers with keen rates. Investment loans were 39.4% of all loans, up again from last month, as the owner-occupied lending demand eases. Looking at all of the categories of loans month on month, we see that lending for owner-occupied construction fell 1.2%, lending for the purchase of new dwellings was down 2.2%, lending for the purchase of other existing dwellings was down 1.7%, while investment lending for the construction of new property fell 2.5%, investment property for individuals fell 0.6%, and investment lending for other entities such as self-managed super funds dropped 2.2%. There's been a tightening of lending in that sector. As a result, total flows were down 1.1% compared with last month. First-time buyers were also down in number in September, looking at the original data, falling by 8.8% to 8,693 new loans. This was 18% of all loans, which was up from 17.8% last month. Looking at the individual elements, overall first-time buyers were down, although overall more loans were written with a fixed rate in response to the battery of cheap rate deals which were on offer. Our first-time buyer tracker shows the lower trends, especially as the number of new first-time buyer property investors continues to slide. In fact, they're really now hardly an important element in the numbers. Finally, the overall loan stock rose in the month in original terms, with owner-occupied loans up 0.3% or $3.4 billion, and investment loans flat, giving a total of $1.68 trillion, up 0.2%, and continuing the slowing trends. We think lending growth will continue to slow as prices fall further and lending standards continue to tighten. While some slack has been taken up by the non-bank sector, reduced credit means lower home prices ahead, and we think that we are now entering the danger zone where effectively the lack of credit will drive home prices considerably lower and probably more quickly than many expect. Finally, a quick reminder. Our next live Q&A session is now scheduled for November the 20th at 8 p.m. Sydney time. You can schedule a reminder by using the YouTube link and join in the question and answer session in the live discussion, or send me a question beforehand. And if previous sessions are any guide, it should be a lively event. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. The link is in the comments below. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.